dividing this top by our bottom, getting a ratio, and in this case I'm using the square root of the ratio. Multiplying that times this top will give us this level. That turns out to be our next top, so we're hesitating at our level, and we have our trend line coming up, so it's not a surprise to us when it breaks here that it's going to go down. If it gets through here, it bases on this level, goes up. Here's the next level. Well, it blew right on through that, and it comes back and it rests on it. And even when it broke the trend line, it rests on it. So now we know it's probably going to approach the next level. When it gets there, it blows right on through, and we're watching for it on our next level where there's a trend line coming up, which clocks it right there. Then it pulls back almost to the level, gaps on through, still a lot of momentum, so it's probably going to go to this level. But we see in each case, this first impulse wave, in terms of a ratio, gives us all the support and resistance we ever need to know. And then with some simple trend lines, we throw in a measured move or two and a few other things we'll learn in a minute. We have pretty good areas to do our precise support and resistance entry and exit points, because that's what we're looking for, is an accurate entry and exit point. Finally, I might add that whenever we do have an impulse wave, like the first top here, what we want to do is adjust it to a universal vector. In other words, if this stock had just gone up like a rocket ship, very strong, we could have seen a circular arc of the same vector. We've spun an arc in a circle around this, and the maximum that vector was equal to would be a price this high. So I've just taken this momentum, I've converted it to a circle, moved it back here, so the theoretical maximum would be along this level. Knowing the theoretical maximum, I can make a time cycle out of it by turning it into a box. So this is a time cycle that is equal in time to the theoretical maximum price. When we make a box out of it, we see that this works. There's a big breakdown in a gap right at the end of our time cycle. And if in the middle of this, we put one of our angles up through the middle of our little box, it times the next top and catches it. And if we subdivide the middle into the quarter point, we can also subdivide this for a trend line, and at times our next top too. This is also viewed something like this with a circle. We make a circle go back. Remember our rule, as much as they go up, they have to go down or sideways. So this is a consolidation decline pattern. Should be a low over here. It's going to be going sideways. Then it turns up. If I put an angle through the midpoint here, it points to where we're going. It hits our next radius top, which is twice the first one, but you're resting on our first target of the top. When we're resting on it and we turn up, ultimately that means we're probably going to get to our target up here. And the next top is going to be this little angular one that rests again. So the next top up here would probably be when this blue arrow intersects that, will be resting on the top. So we can use the circular measure of the initial impulse wave to measure target objectives. Here's a little 15-minute S&P showing the same thing. As much as they go up, we turn this into a circle, and then we double the radius of that circle to this one. Then we double again that one to this one. So this one's like 4 times bigger. And as much as they go up, there should be a low in here. Well, in this case, it was very early and it was very strong, so it was supposed to be a low. It just gapped down to our low in here, regrouped along the circle, and then it went on up. It hit the circle of resistance from here. The 45-degree angle coming up gave it one last impotence, and it went up and hit its head on our maximum resistance. So here again is our idea of doubling. We get a radius vector, and we double that, and then we double that for a quadrupling. And these would give us support and resistance targets. We also have what's known as equal balancing targets. Often if you exceed a certain level, you will go twice that distance. So on this last leg up, when they broke down, we can take the distance of the last leg up as a fundamental measured move, so to speak. So when we violate it over here, we can have an ultimate objective of twice that distance, which would be somewhere down here. And along the way, as we have our little 1, 2, 3, 4, 5 waves and things going along, we can also subdivide and take our last little waves, this distance here, and measure that one down too. And so we get 2 targeted objectives for a low somewhere down in this range. And this basically is another way of getting target objectives. Let's turn our attention now to a few other topics. One of them would be stop losses and how we protect our capital. We haven't mentioned much of that as yet, but there's various techniques you can use. Stops are always used initially because you're entering a trade at a very uncertain point. You're usually buying a dip, which is a small downtrend, in an up move. But it is a downtrend, and it may last forever, and it may keep going right on through you. You don't know that it's only a dip at that point. You just have a high probability that you're buying a dip within an uptrend. So you do need a stop. So even though you're buying at exact support, you put a stop under that exact support. And stops are also related to risk management. They frequently can be controlled as small as 1% of your capital. And if you're trading commodities and very leveraged products, you never really want to expose more than 1% in any one trade. Let's face it, on any given day, most stocks in the market averages can easily fluctuate 1% a day. And if you could make 1% a day on your trading capital, with 250 some trading days a year, you would make a lot of money. So you don't really want to risk a lot more than 1% in many occasions. But occasionally, if you're going to swing trade something for 6 weeks or more, you may need a big stop, as much as 10% of your capital. It's not unheard of. But usually 1 to 3% is about right. If you're trading a $70 stock, 1% is 70 cents. Usually you should be able to scalp a trade that's within 1% of the target price. And most scalps these days, if you're buying 1,000 shares or 1,500 shares or 3,000 shares or 5,000 shares of a stock, and your goal is only to make 30 cents or 50 cents or $1, your risk and trailing stop should be commensurate with that. So 1% may be an area to think about. When you're trading S&P futures, they're very volatile. So I usually find that a big stop is preferable initially, just so you don't get stopped out. And it's been my experience that a fairly wide stop is better than a short stop. Because if you know what you're doing and you're trading with the trend, you'll be able to take a profit and be out of the trade 4, 5, 6 times before you can get stopped out. Whereas if you use a very small stop, 1 or 2 bars back, you'll get whipsawed quite a bit. Also, when you're trading S&P futures and you have a profit for more than 15 minutes, always move your stop up to your cost. There are almost no commissions on S&P futures or even on stocks these days. So if you have a profitable position, never let it turn into a loss. It's always easier to get stopped out and reposition yourself than to lose money on it. Initially, you have to have a losing stop because anything could happen. There could also be a war or some rumor or something, and the S&P futures drop 20 or 30 points. You need something on the books to stop yourself out in an emergency. But once you're in the trade for a while, you move your stops up. Always use that rule too. You can break 1 but not 2. So usually, initially, you may go back to the low of 2 bars back, but maybe you give it a little breathing room. Maybe you want to have 2 bars back on a 15-minute or an hourly chart, even if you're using a 5-minute chart. Now, a lot of the idea behind a stop loss and money management comes from the idea of trading too much. You lose a little something every time you trade. Nobody is perfect, and you're going to make mistakes a lot. And while you can let your profits run and have small losses, you can also trade too much and have a great many losses. So statistics tell us that the probability of success is defined by the multiplication of the individual factors. If you're right 70% of the time, and you'd be a very good trader to be right 70% of the time, the probability of 2 trades in a row being correct is only 70 times 70% equals 49.49, which is less than 50-50. So you can't, if you're a 70% probability trader, you're not going to even be a 50-50 chance of being right 2 consecutive trades in a row. And trying to get 4 winning trades in a row is a 0.7 times 0.7, etc. It's only a quarter. That's your chance. 1 out of 4 times you might get 4 winning trades in a row. So we know from this that over trading can really cost you a lot of money. And it's better to be a swing trader where you buy something at a good entry point and hold it for a great many hours or several days even, and try and get several points, maybe 10, 20, 30 points on an S&P future, rather than scalping out 50 cents here and there or $1. So we usually have the motto, let your profits run and cut your losses quickly. Now, I was surprised one time working in a day trading firm where we had a lot of statistics, and the guy giving us the statistical printouts on all our stuff had a little seminar to explain all these various factors that we had on our sheets every day. And I noticed on mine, he even pointed out that I had a very high percentage. I was almost 85% accurate on my overnight trades, and my intraday trades were pretty good too. But he said, surprisingly, the most profitable trader in the entire firm, and this was a guy I knew to make millions of dollars every single month, was only right 40% of the time. That means 60% of the time he was wrong in his stock selection. He was either short when he should have been long or long when he was short. Yet he made the most money of anybody because he immediately stopped himself out on his losing trades and he reversed position. So that really is the key. Stop yourself out, cut your losses very, very quickly, and try and get with the trend. I had another trader tell me one time, the head of a big trading firm, he said what he used to do to test his traders, he would both make them trade a stock, and he'd flip a coin, and one would have to trade it on the long side, and one would have to trade it on the short side. And then they could do whatever they wanted the rest of the day with it, but that would be their initial positions. And at the end of the day, he would know which was the better trader, because one guy would immediately know he was wrong and reverse positions, and the other one would be lugging around a losing trade. So even if you flip a coin to go into which way you're going, if you cut your losses and then turn around and trade with the trend and let your profits run, you can be profitable by the end of the day. If we want to be profitable, we want to be very careful about where we enter our trades. So a lot of times we should think quite a bit about where we're going to enter our trades. Here's a couple ideas here. Try and make sure the prior bar had a lower low and a lower high. So it's really in a tiny downtrend, but you want it to be near and above your reversal signal bar. So if you're going to buy, make certain that the high of the low bar has already been seen a day or 2 or 3 before, several bars before. Then it's had a little rally and is pulling back. And now you're going to buy that dip going back towards the high of the low bar. Make sure your entry bar is closing on a strong upper 1/3 of the range. That way you're in a big momentum bar when you enter your trade, and you can use a stop at the low of that bar or even the midpoint of that bar, because a strong momentum bar will usually carry through the next day. If it doesn't, there's something wrong with it. If you had a reversal bar a couple bars back, look to see if you've had a couple consecutive wide range bars already. Sometimes if you wait too long for an angle or something to be broken out on the upside, you'll miss a trade. So usually if you see 2 big wide range bars, I just buy at the market with the stop at the midpoint of them. Also try and wait for a 45-degree angle or the adjusted 1x1 angle down from the high to be exceeded, to be certain that the reversal bar is not just a whipsaw bar that's going to go right back down again. This is not always needed, the waiting for the 45-degree angle down, because sometimes in a waterfall decline, you would have quite a significant advance before you even get back to the 45-degree angle off the top. But in many cases on short-term charts, 5 minutes, 15 minutes, it ties in or coincides often with the signal reversal bar. And always try and trade at your exact support and resistance numbers. Don't just let the market tell you what to do. especially on the opening every day. You may come into the morning thinking the market's going to be bullish, and it is, and immediately they jump up and they